now we come on to Harry, who works for S-Tax. This is the third of our special guests. Now, S-Tax are specialist real estate tax advisors. We want to stress they're not accountants, they like to stress that, but what they do is they do the things that most accountants don't do in maximising your returns. So over to you, Harry.
Yeah, thank you very much, guys. And good evening to everyone. As I've just mentioned, my name's Harry, and I'm the communications manager here at S-Tax. So what I'm going to talk to you a little bit about today is capital allowances on furnished holiday lets, your short-term lets and kind of flexible letting. Going to try and keep it nice and concise today. Two reasons. We want to leave a bit of time at the end in case there are any questions. And also, I don't think I've ever heard anyone complain that a presentation about tax was too short. Without further ado, let's kick on with the first slide. So what are capital allowances? Well, I suppose to the man on the street, they're essentially the tax-approved form of depreciation. So they go to reduce the amount of taxable profits you make and therefore the amount of tax you pay. So when you're running the course of business throughout the year, you're going to end up at the end of the year with an accounting profit. So essentially your sales minus your expenditure throughout the course of the year. And now to get to your taxable profit, you're going to go through a whole lot of different tax adjustments, one of which being capital allowances, which essentially, as you can see on the screen now, drive down the taxable profit and therefore reduce the amount of tax you pay. And the result of that, of course, is that means more cash in your pocket because it's not cash you've had to pay to HMRC. But what do you actually claim them on? Well, essentially, it's a plant and machinery-based relief. If you guys have ever spoken to your accountant and they've mentioned capital allowances and plant and machinery, they may have mentioned it's an unbelievably broad term in the world of tax and accounting. So it can literally range anywhere between a tractor in the field in the agriculture sector, fleets of lorries, vans, desks, computer equipment, and a whole host of different items beyond that. So it is a very, very broad term, and it covers an awful lot of different items. Within the context of something like a holiday let business or short-term let, which you guys might be looking at, it would be the sort of things like your furnishing, so your beds, your sofas, TV stands, chairs, tables, etc. Now, the process by which you go about claiming these is not a very complicated system, because you will pass on your details to your accountant at the end of the year. It's really a case just their end of adding up the invoices at the end of the year and just deducting that from your taxable profit. So that side of capital allowances is really straightforward. The loose items which you just pick up in the day-to-day running of your business. But what we focused on as a firm, and where in fact there's an awful lot of value to be added, is looking at what items are actually in place at the point of purchase. So when you buy a property, you're not just buying just a brick structure. There's a whole host of different items which are actually embedded within it at the point of purchase, which are also claimable for this tax relief. So we've got a number of examples here on the screen now. You've got things like your fitted kitchen, your boiler, bathroom, you've got your plumbing infrastructure, electricity, radiators, and a whole host of different items beyond that. Obviously, they're all very integral for the working of the property. Obviously, if you've got tenants there and you haven't got heating, well, you're not going to have very happy customers, and you're not going to have any repeat business. So really integral to the part of business. The only difference between claiming items which are embedded and claiming them on loose items is that it is still perfectly eligible. It's just a little bit more complicated. It requires both a cross-discipline knowledge of both surveying and tax, as opposed to just the tax side. So it falls a little bit outside the scope of what most accountants would be doing because of that. Kind of somewhat linked to that point, it kind of means that because this isn't always the most known about area of tax, capital allowances in general are known about, but the fact you can actually claim as part of your purchase price means the average investor quite often is only claiming a very small proportion of what they can be claiming. So the low-hanging fruit, the easy-to-spot items which just get passed on to the accountant's desk at the end of the year. When in reality, there's actually an awful lot more which can be tapped to, which just is a little bit harder to get to, which is just buried underneath the surface. So as I mentioned, that the things which are embedded at the point of purchase. Now, a question we quite often get asked as a company is, well, shouldn't my accountant be dealing with this already? And the short answer, which I say, is no, not really. The reason being is, the tax system in this country is unbelievably vast. It's one of the largest in the world. No one can be an expert in all areas. We're purely specialists in this one area, but we wouldn't pretend that we're experts in all areas. So if you've got a question, say, about inheritance tax, we're really not the people to speak to, but we're very good on this one area. It's quite often compared, I think, to the medical profession in some ways, in that you go to your GP, potentially with some chest problems, a few chest pains. You would expect him to pass you on to the cardiologist, the heart expert, but you wouldn't expect him to crack open your chest there and then and perform a triple bypass on your heart. So it's the same thing here. You want your accountant to be doing the general work, doing the day-to-day stuff, and as and when needed, have supplementary services to make sure you're utilising all the tax benefits that you're entitled to as a business owner. So kind of touched a bit about what they are, how they link in with what you do. Run through some numbers with you now. So typically with holiday lets, we normally expect somewhere in the region of about 25% of the purchase consideration to be available in this form of relief. Now, it can go a little bit higher, a little bit lower, depending on when the property was bought and what's in there when you buy it. Quite often with the newer properties, new builds, it can tip upwards to about the 30% mark. But as a rule of thumb, and what we're going to base this example on now, is that a 25% claim. So we've got a property here which is purchased for £500,000. Now, that means we'd normally expect somewhere in the region of about £125,000 of allowances to be available on the property. Now, whilst this doesn't equate to a pound-for-pound cheque from HMRC, otherwise that would mean they were literally reimbursing you for every penny of the plant and machinery which is in there. What it actually does do is reduce your taxable profit by that much and reduce the amount of tax you pay. So based on £125,000 of allowances, that would equate to knocking on the door of £24,000 of, say, corporation tax and a little over £56,000 saved income tax for an additional rate taxpayer. So as you can see there, it's a substantial amount of tax benefit which is going to be tapped into. So really good if you guys as investors wanting making sure you're getting as much from your money as possible. Making sure you've got all your capital allowance ducks in a row is a really good way of doing that. Sorry, gone one slide too far. Just to kind of round off that point a little bit further, I mean, if you're looking to make a return, say, of 5% per annum on an investment property, if you're claiming capital allowances and you've managed to find 25%, what that essentially means is you're going to have the first 5 years of income on that property stream tax-free. So all of you guys here, myself included, one of the biggest expenses we have throughout the course of the year, either in individual or through companies, is the tax you pay. So that goes right across the sector, all businesses. So doing something like this to try and really reduce the taxable profits that you make and reduce the amount of tax you pay in a non-contentious way is something that's really worth giving an awful lot of thought to and a lot of consideration to. So that really rounds off what I wanted to talk about this evening. Thank you very much for listening. We've just touched upon what the capital allowances are, how they're used, and a quick example of what the numbers would look like in reality. You should have my contact details on the screen there. Don't hesitate to pick up the phone, talk to myself or one of the team, drop us a line by email. We're more than happy to speak with you guys and just run through your scenario and see if it's relevant for you and if it's something you want to go ahead with. Thank you very much for listening. I'll pass you back over to you guys.
Just a quick question, Ari. I was looking, obviously, on the last slide, you talk about 5% per annum. Now, obviously, we assume and expect a lot higher in terms of what they can get on a yearly income. I guess that also means that the amount of tax years that they can save sort of comes down, the higher the,
It's essentially until you use that amount of relief. So essentially using that example earlier, so we've got £125,000 allowances. Essentially until you've made up £121,001 profit, you're not going to be paying any tax on that income. So if it means you've got a higher yield, you're getting more income as a percentage of your investment, that's great news. It just means you're eating through it a bit quicker. Also, if it takes a bit longer, you don't achieve that. It's not going anywhere. You've
always got that as thing. And on the right hand side again on the chat, you'll see firstly, there's some information about S-Tax, and also there's an example of a current property that we're selling, and that's based on sort of our rental projections and how far that'll come off. And I think it's 2.5 years because we're expecting a sort of 12% return, something like
Good
that.
to put that into a real life example, isn't it? Which is
which is on the right, so you can download that. And I think it's just fair to say that's S-Tax aren't accountants, so you will have an accountant. It's just this is your specialist area, just to eke out that little bit more of profit at the end of the day, isn't it?
Yeah, absolutely. Yeah, we're not here to replace anyone's accountant. We're just here to kind of offer a service that runs alongside your accountant. As I say, it is a specialist area. Whilst accountants will be very familiar with capital allowances, it's not something that your general firm will be looking at, unless maybe you're with one of the big four, EY, Deloitte and like. They have their own specialist departments. The overwhelming majority of accountancy firms throughout the length and breadth of the UK just won't have that. They don't have the resources to do it. So it is something we can step in to just look at this one section of your tax affairs, and obviously very much leave the rest to your accountant.
And I also think it'd be very worthwhile for anyone on here now that already has investment properties that maybe haven't looked at this option, then get in contact, because I'm guessing you can do this historically, can you?
Yeah, absolutely. Yeah. So it's there's no time restriction in terms of how far you can look back with your capital allowances. The only thing that is worth bearing in mind is it's linked to cost. So if you're looking at properties which were bought in the 80s, say, possibly the numbers involved aren't going to be too exciting for you. There's no time restriction. So even if you just want to get an opinion on something, it's well worth getting in touch. We can have a chat with you and say, well, this is what we think can be achieved, and leave it with yourself as to whether you want to move forward with that. It's also just to kind of flesh out that point as well. I know it's a time of year where everyone's a bit more conscious about their tax affairs than usual. You've got your self-assessment tax returns and this sort of thing. You can also look at historic claims. If you can carry back some of the relief as well, using the amendment window, you potentially trigger tax rebates. So all round is well worth just getting in touch and just seeing if there's something there to be done.
Yeah, brilliant.
Thanks very much.
Perfect.
I really
Thank you.
appreciate it.